Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending June 28th, 2019. The end of June, the first half of the year is over, and we're seeing that even in the land of the blind, the one-eyed is king. But first, let's just kind of take a look at globally what's going on this past week. The US indexes were surprisingly flat to slightly down, just under 50 basis points, most of them. The only one that showed some strength this week was the Russell. It was up 1.09%. Volatility came in dramatically in the last hour of trading this past Friday. It closed the week at 15.08, so it was down a little bit from the prior week. It closed at 15.40 the prior week. But the world markets, again, they were pretty much all in the green, just slightly up, a little bit under 50 basis points mostly. China was the only major index globally that was down about 0.75%. Best performing sector for the week was materials, up about 1.7. Worst performer was utilities, down about 2.14. Now I'm looking at the trailing PE ratios in the S&P 12-month trailing numbers, 22.84, but the forward PE ratio is at 17.72. So you can see that the markets have taken about a little over 22% of the value out of the PE ratio. So they've reduced the value. And even then, it may not quite be enough. I mean, the first half of the year is in the record books. Performance is really strong. I mean, the S&P was up over 17%, NASDAQ up over 20%, almost 21%, Dow up about 14, the RUD up 16%. But if you include the Q4 numbers into these numbers here for the first part of this year, year to date, it's not so rosy. The S&P was down 1.75%, NASDAQ down, right? 3.67. The Dow was down 2.5, and the Russell was down 9.48%, almost in correction territory. So keep in mind, Q4 was so ugly that we had a huge bounce that's kind of continuing to this day through June, right? But when you start to include other numbers, the markets don't look as strong as just the near term. I mean, we're focusing, and the trader and the human condition is traditionally to focus on the most recent activity. But when you start bringing in Q4 numbers, it doesn't look as good. I mean, even in June, we saw the S&P futures from the low to the high. It was down up almost over 8.8% from the low to the high, right, for June. And May was down about 7.1, so they gave us that V bottom. But June, it was the best June we've had since 1955. But then again, that's not the only thing that did good. If we look at the debt market, I mean, the debt via US Treasuries, they turned in a great performance. 30-year bonds were up 6.34%, which drove the yields down. I mean, the 10-year dropped 32.33%. The yields closed about 2%. So markets are kind of taking an interesting take on the current economic behavior. Bonds are showing there's going to be problems ahead. Equities are saying full steam ahead, right? But if you kind of take a step back, like I keep trying to, force you guys to do, since 2018, the S&P has been relatively flat. I mean, we're making higher highs, but barely. And the earnings guidance for the second half of this year is lower. So it's not, we're not going to see the performance measure up for the second half of the year that we've seen for the first. And that kind of puts the Feds in a pickle. Because this is the first time I've seen this, but the Fed Fund futures is pricing in about 100% basis cut. 100% probability of a 25 basis point cut in the end of July for this next Fed meeting, right? And they're forecasting in 3 rate cuts for the year. I think Morgan Stanley is forecasting a 50 basis point cut for July. So anything short of some of this for the rest of the year is going to put downward pressure on the markets, right? So that kind of puts the Feds in a pickle. And on an inflationary perspective, we got to kind of take a step back here again, guys, and look at the global macro thing. We've been kind of in a deflationary mood, I guess, for the past 20 years, mostly because of the rise of China and offshore manufacturing. So it's kind of created an overcapacity in this manufacturing offshore, bringing cheaper goods to the U.S. So it's kind of imported a deflationary kind of environment, which makes it harder to rise or raise inflation. And when you add all this massive debt and more money to the system that we've seen over the past decade, you can easily create overcapacity and bubbles on the front end side. So that kind of makes it even harder to maintain higher levels of demand. And it takes more and more credit to do that, or lower interest rates. So they're kind of in this vicious circle, right? And eventually this circle jerk's going to end, to keep price action moving higher. So this does set up over the horizon the next year or two more possibly recessionary type environment. Okay. But net over the past 10 years, since we started this massive debt buildup, since the 2009 lows in March 6 actually, the S&P's returned on average about 15% a year compounded, all right, including dividends, which is the dividend yield in the S&P is about 1.9%, right? So that's allowed index funds to take a larger percentage of investable money. Index funds are funds that don't try and pick winners and losers. They just plop their money in the entire index. Don't find the needle in the haystack, just buy the haystack. And that's what we've seen over the past 10 years, and it's worked well because we've had that 15% per year compounded return. But I guarantee you that's not going to continue. Markets change, environments change. You've got to change with them. Going forward, I think I could see the annualized yield of the S&P falling below the 50-year average, right? We're well above the 50-year average at this 15% compounded annual growth since 2009. The average is like around 8%. So it's going to fall back, but it's not going to fall back to the average. It's going to, like the markets do, always overshoot to the upside and to the downside. So that puts our annualized yield probably over the next decade around 3 to 5%. And we could have a bear market in the middle of that, but I'm just talking about on average. So that's going to reduce money and shift money from these big index funds to more actively managed funds. So we're going to see that kind of take place, not on a daily or weekly basis, but over the next decade, you're going to see that happen. So we're going to see some shifts in how money is going to be moved over the next decade compared to what we've seen over the prior decade. And you guys remember the phrase irrational exuberance that was coined by Alan Greenspan back in 96. And that was in the second longest, which is now it was the first, but now it's the second longest bull run in the history of the markets in the 90s, right? And he came up with that term, irrational exuberance, which what we take today as FOMO, the fear of missing out. But remember when he coined that term, it took another 4 years before we ran into the dot-com bubble in 2000. And then, NASDAQ lost over 88%, 85% of the index. The Dow or the S&P was down, I think, 55%. Okay. But it took 4 years. So it shows you how long that FOMO trade can run. So for all we know, we've been in this FOMO trade for several years now. But all things come to an end, guys. So against this backdrop, and slowing economic growth supported by all this cheap money, the other thing that I've noticed, we can still have the FOMO move up a little bit higher, which is what I'm also seeing as well. I think we can have that before everything kind of gives itself up. But I mean, speaking of debt, though, I talked about debt, showing that trouble ahead, but we've got these low interest rates. I mean, Austria took advantage of it. They're smart. They issued a 100-year bond a year or so ago and for 2.1%. And keep in mind, there's still 13 trillion in debt, a lot of it over in Europe and in Japan, that is yielding negative interest rates. So even in the land of the blind, the one-eyed is still king. So even though it's a low interest rate, 100 years out, right? 2.1%, but that still looks good. So that's why I'm surprised right now, Trump, who's like the king of managing debt, or I might add manipulating debt, right? But he's king. He knows what he's doing when it comes to debt. I'm surprised he hadn't forced the Treasury to figure out a way to issue US 100-year notes or bonds. I mean, I think they're going to do it, at least 50, but certainly 100. I know Mnuchin, he's very smart too. They're looking at it because what better way to take off the table the prospects of rising interest rates doing dramatic harm to our budget deficit with 3.5 or 4 trillion in debt, but just to friggin' move it all out 100 years and lock in a low rate. I mean, that's what I'd do. And it just locks it in. So that takes that off the table. So I think we're going to eventually see something that like that, before Trump's term is over. I know they've looked at it, but let's see what happens. Now, if we look at the markets here, you can see this big V move from the bottom to the top right here. From the high here at the beginning of May to the low here is about 7.1% right here. And then from the low in June to the high in June, it's a little over 8.8%. And we've kind of settled in here near our all-time highs. So I do believe we can move higher. You can see here my target. Let's just back it out. Let's put it on a weekly chart here. You can see my target was hit right here when I put it up at the beginning of the year. My target at that point was at 29.64, and we hit right on. And I've left this on the chart. My next target is right around 3,100. Again, just remember Alan Greenspan and his irrational exuberance comment in 96. We had another 4-year run before it finally gave it up. So, who's to say that we haven't been in this irrational exuberance run for a year or two, right? And 2018, beginning of 2018 is just kind of the first starting point where we've kind of gone nowhere. You can see the highs in 2018 were at almost 2,900, right? 2,879. And we moved from 2,879 up to 2,953. So about 75 points, 70 points or so in the past year and a half. So we're making new highs, which is the definition of, but we're not making new lows. I mean, we made a lower low here, so it kind of upset the apple cart here. I attribute this final 5 to 7% push lower with a Fed miscue. All right, I've gone into detail on why that happened, so I'm not going to do it here in this session, this weekend, in this roundup. But you can kind of see where I do believe we got some FOMO to the upside, and then it's going to start to get a little bit ugly. But keep in mind, it's teed it up nicely going into earnings. And this weekend, we saw Trump and Xi give the markets what the markets were looking for. All right, the markets had a very low bar. They're not going to complete a trade deal. All the markets were looking for is that Trump was not going to do more tariffs. He's going to give time for negotiations to work. And then Trump comes out and basically says what everybody thought he would say. We're back at the table. Xi's my best friend. We share milk and cookies together and nap time together in the play field, blah, 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 that kind of thing. So the markets are going to get what they expect. So that clears the deck now going into earnings. Now, next week, we'll see the markets probably lean to the upside a little bit because it's going to be a holiday shortened week here in the U.S. So all of you watching this update, and even our members, a lot of international members in our group, next week's a big holiday with Independence Day, July the 4th, coming up in the middle of the week. So markets close on Wednesday, 1 p.m. Eastern Standard, New York City time. And then they don't open again. The equity markets don't open until Friday morning. So that's a day and a half. Futures markets will open Thursday Thursday, July 4th at 6 p.m. Eastern Standard, New York City time. But we're going to have that big hole in the middle of the week, and volume is going to be low, and a lot of traders are going to take Friday off as well because it's kind of fallen in the middle of the week. So expect very low trading volume. And the big number coming out next week is going to be the labor statistics, employment numbers, non-farm payrolls numbers coming out on Friday. And the Feds are going to be watching these numbers very closely. Okay, so that's what we got. And then right after that, we move right into Q2 earnings, which guidance has already been lowered. So the bar has been set for us to move higher. All right. And if the Feds do their 25 basis point rate cut, markets are going to continue to put pressure on them via the bonds to do more cuts. So that's kind of what I'm seeing here. And if we look at the VIX, look at what happened to the VIX. I'm going to put it on a 15-minute chart. And you can see right here, going into the afternoon hours, right here, right around 2:15 before the markets closed at 4 o'clock, the VIX went from about 1612 to close at 1508, right? I mean, a 1.04 move in a very short period of time. A lot of this was rebalancing. It was a quarter in. Typically, the Russell goes through a rebalancing act. We're also seeing rebalancing in debt and equity because a lot of big funds hold a 40-60 ratio of debt and equity, and as debt starts to continue to climb, that means they have to sell debt and buy equity to keep those ratios in alignment, okay? Because a lot of these big moneyed firms hold that standard ratio. So you see these rebalancing going on at the end of the period. And look at the E-minis, the S&P 500 on a 15-minute chart. Look at this. I mean, we were down here literally to show you how fast this rebalancing happened. At 3:30 in the afternoon, the E-minis were at 29.34. They closed at 29.53, almost 20 points up. I mean, we moved, the E-minis were almost flat for the day. And in the last 30 minutes, it closed up here. That's rebalancing, folks. That's big money coming in at the very end of the day. They don't typically do it in the middle of the day because you could get more movement. So they're holding it out to the very end, and then bam, these orders trigger. And that's what caused it to happen. And that caused vol to fall off the table. All of this was stored up. And you typically see this, and you don't know which way it's going to go, right? But this was a rebalancing act just because of the nature of how the market's set up. Boom, we went back up like that, right? And of course, if we look at the front month vol skew, you can see here with that big rebalancing act here on this 15-minute chart, you can see we were literally on Friday, we were in a backwardation mode here when markets started moving lower, and then boom, we came right back down into a contango, which is a normalized vol skew, right, with that rebalancing. So that sets us up for next week. And if we look at the back month, we were never in a contango environment to begin with. You can see here we're well down here like this. So the vol has set us up for the more FOMO move to the upside. You know, and if I shift my screen here just to show you the, let me just get a, let me get this screen up like this. I'm going to show you a Bollinger Band chart, but on this Bollinger Band chart here, I've got 3 standard dev instead of the traditional 2. The third standard dev is the red line. So notice on any up move, when we start moving up, like right here, markets tend to move 1 standard dev above the norm, and they stay between the 1 and the 2 standard dev. So you can see the blue line is 1, the purple line is 2 standard dev, and we tend to just ride that number up. When markets fall, they fall faster than they rise, obviously. So we tend to go from 2 to 3 standard dev. So you can see the purple is 2 standard dev, and then the red is 3 standard dev to the downside, right? And then we move back up to the center and we come back down again, hugging the purple line on the way down, generally. So now you can see we've kind of been moving up between the blue and the purple. This is my short-term target right here around 3,000. Longer term, I said around 3,100. Okay, and then if I show you the same chart but on Ichimoku, right, and we cover a lot in the Ichimoku in our option masters, but here you can see the Ichimoku, it's showing the same thing. We're in a bullish mode. The cloud is down south of us. My target here is around the 3,000 area, 3020 area right here. You can see solid support underneath here at about 2877. So it sets us up for a run if we get Q2 and remember, Q2 earnings forecast, the bar is very low. So it's going to be easy to hit that bar. And if the Feds come out and cap it off with another rate cut, 25 basis points, keep that in mind. It's already been factored in. And they kind of give us a little bit of a we stand ready to act kind of thing. Rates are good right now, but we stand ready to act and support the markets and the economic expansion. That's going to be considered dovish. Then I can see as FOMO our way all the way back up to this level here, or to my longer term move up to around 3,100 before things start to get a little bit more dicey. Okay, so that's kind of what I'm seeing in the marketplace from that perspective. So keep in mind that we've just had this compounded run in the S&P, about 15% per year for the past decade. And then going forward, that's been too much. So I think it's going to drop back down to around 3 to 5%. So as I said, index funds have played this very well, but I think we're going to see money shift. And I think it's going to give us a lot of great opportunities in the market, guys, really. And if we look at the bond market, I'm going to get the bond market up here. Let me just shift the screen here again. I'm going to just fix my screen here. I got like 12 monitors I'm trying to play with. So it's like my toy, right? Once you get used to 12 monitors, you don't want to go back. I guess the more monitors, the better, huh? So here's the bond market. And you can see here in the bond market, you know, we're up dramatically. I would be more willing to short this than go long here. Because even if they do cut by 25 basis points, if they kind of hint that that's where they're going to stay for a while, maybe until September, I think you're going to see bonds sell off. I don't think you're going to see bonds go up, because remember, this move here is already based on a 25 basis point rate cut. In fact, they've got three. Morgan Stanley's come out with a 50 basis point cut the end of July for the next Fed meeting. So I just think the risk of a bigger move right now in the bonds is to the downside. Not by much, but I think there's going to be sideways to downside pattern movement in the bonds. So that would be the way I would look at that. And as I told our members, the best way to play it, I've set them up for a really good way to play that. If you're not a member, I highly encourage you to come in. We got some great offers out there on the table for you. Take advantage of it, because just any one of our trades will, cover you for a year or 2 years, 5 years out, right? Easy. Um, Currency wise, well, the dollar is at the bottom of the regression channel. You can see here, as we step out, the dollar's at the bottom of the regression. Remember, right up in this area here, I said you want to go long euro dollar, and then the dollar's come down, the euro's moved up. We're in the regression channel, but I don't see any need to go long right here, unlike down in these areas down here, because we had divergences down here. We do not. So that suggests the dollar can actually break this and go lower. And if we look at the euro, it's been in a down move all the way since the summer of last year. But you can see here that we've broken the regression channel. We're holding the 200 EMA, okay, to the upside. And there is no divergence here. So this would suggest any down moves probably going to be bought. So that's the only reason why I'm not going long euro dollar or shorting dollar euro. I would be more inclined to support a weakening dollar. And this is, I'm sure, keep in mind that Power Ranger Boom Boom Powell and Super Mario Draghi are on the phone talking to each other. They don't want the dollar and the euro to get too far out of whack. So they work together to create policies and plans to support the euro, weaken the dollar a little bit, and so forth. So that's kind of what we got going on here. All right. The yen, in times of global strife, you can see here with the yen, this was in December, right? So the yen, money rushes to the yen. And then if you look here at the beginning of May, money rushed into the yen. But if we look at June, we've had a huge move higher in the markets, but the yen continued to show strength. So that just shows that even though we've moved strong in the month of June, globally the markets are still concerned. If we get a China trade deal, the yen's going to come all the way back down. That would be a good short. FXE, Foxtrot X-ray. I'm sorry, Foxtrot X-ray Yankee, FXY, if you don't want to trade the futures market, or Forex. But this would be right now, I'm not convinced that the yen is going to go lower near term. All right, I don't see any divergences in any of my indicators. It suggests that any lower move is probably going to find support right around this area here and move higher. So we're going to just hold off on that for now. The oil is going where I said it would go. All right, I said the mid 50s, and now my value area is at 57. And near term, it could go anywhere. Keep in mind, we got OPEC plus one, that would be Russia, meeting this July 1st and 2nd, Monday and Tuesday. uh, Rumor on the street is they're going to leave production cuts the way they are. They're not going to change any policy, but they're going to maintain their production cuts. So that would be supportive of oil. We got the geopolitical event with Iran and the US. That would be supportive of oil. The only thing that's pushing oil down is the global issue. If global markets continue to slow down, it would put downward pressure on oil. And geopolitical events, near term always win out, but longer term fundamentals always win out. That would be supply and demand and global growth or lack thereof. So that's why we've gotten this really screwed up move here in oil. Remember, back in this area here, I was telling folks to short oil, made some good money on it. Back here late December, I was telling people to go long oil. And then back at this peak here, I said short oil. All the while saying that the mid 50s is where oil should be. So anytime we get too far away from that, then markets will self-correct back in. But oil, like the markets, and FOMO always overcorrect both to the upside and the downside. So right now in oil, I have a no trade on. I want to get through next week, and let's see what OPEC does before there's any interest in my part in making something about oil. Gold, we had a great trade in gold. Let's put it on a weekly, and I'll show you what I mean. I had forecasted, and this pattern right here. Once we break this pattern to the upside, you can see my forecast. It's been there for the past several weeks. As you guys know, I'd forecasted about 1410. We're at 1412. Once we break that, that's where our near term is going to go. Okay. Now, what could move it higher? Well, if we have more global slowdown, low interest rates, money doesn't mind gold when interest rates are low. You can see we hit my target just slightly above. I would not be surprised to see a retest of this breakout area around 1372, 1375 area, and then a move higher. There is no divergences here, so this does suggest that any sell-off is probably going to be bought, but I'm not going to chase it up at this level. Okay, so that would be the gold market near term. And of course, if we look at palladium, I want this sucker to keep going higher because maybe we can have another mother short. We shorted this one up here, and we had members making 24 to 30,000 per contract. I want it to get higher, but I want to get a signal. So that means if we sell off here near term and then move back up, that would be a good thing, believe it or not. We may not get that, but that would be, I would be more willing to sell it than buy it up at this level. Okay, so that would be another possible setup in palladium. Now we've got some things going on in agriculture related to the China trade deal. Same thing with meats and softs. Members, I'll go through that in more detail with you this Sunday evening, as well as some of our trades and some of the stuff that we're running. If you're not a member, I highly encourage you to come in and join us. We're having a great time this year. Last year was a great time, and I see the next 12 months, I think for the normal trader is going to be even more difficult. There's going to be surprises out in the market, but we've got a way to take a look at that and make plays that I think are going to surprise a lot of markets participants. Have a great weekend, everybody. Members, I'll see you this Sunday night. Next week, a holiday shortened week, so volume is going to be low. Just be prepped for it. Have a good one, everybody. Have a great weekend. Ciao now.